It's kind of wild when you stop and think about how often we bump into AI, like, every day, maybe without even noticing it. Recommendations on streaming, how your phone camera just knows how to frame a shot, it's everywhere. But what happens when this quiet revolution starts changing something as, well, fundamental as your bank, especially, say, your regional commercial bank?
It's a really good point. We're looking at a fundamental shift, a complete rewiring of how they've always worked. It's this convergence, of advanced automation, predictive analytics, and these new autonomous systems. It's not just a small upgrade.
Not just tweaking things around the edges.
Exactly. It's really about redefining what they offer, finding totally new efficiencies, and building these much deeper data-driven relationships with clients, stuff they just couldn't do before.
Okay, so to help us navigate all this, we're digging into a really comprehensive report. It's titled AI's Impact on Regional Banks. Seems like it gives a pretty clear picture of the opportunities, yeah, but also the really big challenges.
It does. It lays it out quite starkly.
So our mission today really is to cut through the buzzwords, pull out the important bits, and help you get a handle on what an AI-native bank actually looks like. And, what that means for financial services down the road and maybe even for your own banking. So yeah, where do we start unpacking this technological cascade?
Right, the cascade idea. It's helpful because these technologies really do build on each other. Think of it like layers in an intelligence stack.
Okay, layers. So what's at the bottom? The foundation.
At the very base, you've got process automation, RPA, robotic process automation. Think of these as the digital hands of the bank. Their job is basically automating tasks that are high volume, repetitive, follow clear rules. And importantly, they do this without needing to rip out and replace the bank's existing IT systems.
Digital hands. I like that. So speeding up the grunt work, what kind of tasks are we talking about at a typical regional bank?
Exactly, the grunt work. Things like data entry when a new customer comes on board, those KYC, know your customer checks, processing accounts payable, updating ledgers, even handling the really routine parts of putting together a loan application.
Okay.
An RPA bot, for instance, can pull data from a loan form and stick it into the right system fields in like seconds. A human might take minutes, and, humans make typos.
Right, errors creep in. Okay, so that's the base layer, the hands. What's next up in the stack?
Next up is where it gets, smarter. Traditional AI and machine learning, or ML. This is more like the bank's predictive engine, or maybe its brain. These systems go beyond just following preset rules. They chew through huge amounts of data, find patterns, spot things that look weird anomalies, and predict what might happen next.
Okay, so moving from just doing to actually learning and predicting, what's a good example there? How does that change things for a bank?
Credit scoring is a big one. AI can often make more accurate and sometimes fairer lending decisions, especially for, say, small businesses or people without a long credit history. It looks at more data points. Or think about risk management. AI can sift through millions of transactions looking for really subtle fraud patterns that older systems, or even people, would likely miss.
Any real-world examples of that paying off?
Yeah, the report mentions HSBC.
Yeah.
They use AI for compliance work and saw something like a 2 to 4 times improvement in how accurately they detected financial crime. Plus, they cut down the false positives, the times the system flagged something innocent by 60%. That's a huge efficiency gain and better risk control.
Wow, okay. Better detection, fewer false alarms, that's significant. So after RPA and traditional ML, we get to the one everyone's talking about, generative AI. GenAI. Is it just about chatbots?
It's definitely powering much more sophisticated chatbots, yeah. Like Bank of America's Erica or JP Morgan Chase's Finn. They can handle really complex human-like conversations. But GenAI is broader than that.
Yeah.
It's a real leap because it specializes in creating new, original content and synthesizing complex information that isn't neatly structured. Think of it as a creative and synthesis partner.
Creative partner. Okay. So beyond chatbots, what else can it create or synthesize for a bank?
Well, it could auto-generate parts of a credit memo, maybe draft personalized marketing emails that actually sound like they were written for you. Or it could take a huge, dense regulatory document and spit out a concise summary in seconds. It's generating new value from information, not just processing it.
That's a big step up in capability. Okay, and then you mentioned one more layer right at the top, Agentic AI. That sounds advanced.
It is. It's really the cutting edge right now. Agentic systems move beyond just responding to a specific prompt from a human. They can proactively plan and execute a whole sequence of complex steps to achieve a goal you give them. And they do this with minimal human oversight. It's goal-oriented, autonomous action.
Okay, hang on. So instead of me saying, rate a summary of this client's risk, I'd give it a bigger goal.
Like, continuously monitor this client's portfolio and execute pre-approved hedging strategies to keep their risk score below 7.
Wow.
And the agent then figures out how to do that. It monitors the data, identifies the risks, decides on the right pre-approved action, executes it, learns from the result, all on its own towards that goal.
That's quite a leap. So these aren't separate boxes then. RPA, ML, GenAI, Agentic AI, they work together.
That's the key insight, really.
Right.
They're not mutually exclusive at all. Their true power comes when they're integrated, woven together into this synergistic intelligence stack.
Yeah.
Each part does its job, feeding into the next, creating a workflow that's way more powerful than any single piece on its own.
Synergy. Okay, paint me a picture. How does that integrated stack work in practice? Let's take that commercial loan application you mentioned.
Okay, sure. So the application comes in, step 1. RPA bots grab all the data from the forms, the financial statements, whatever documents are attached. They extract it, clean it up, populate the bank systems instantly. Step 2. A traditional ML model takes that data, maybe pulls in some external economic indicators too, and generates a sophisticated credit risk score and analysis. Step 3. A GenAI tool then graphs a comprehensive credit memo. It synthesizes the risk score, the applicant data, maybe flags key concerns, puts it in narrative format. Step 4. An agentic AI system whose overall goal is maybe optimize the lending pipeline efficiency takes all that input. It might then autonomously notify the human relationship manager, generate a personalized email to the client with a conditional offer, schedule the next review meeting, basically orchestrating the whole process flow.
Right, coordinating everything automatically based on the outputs of the other AI layers. That level of integration, it sounds incredibly efficient, but maybe also complex to manage. Does it create new risks?
Oh, absolutely. Integration itself is complex, managing the handoffs, ensuring data integrity, oversight, there are definitely new challenges. But the report argues pretty strongly that this deep integration is where the future competitive advantage lies. It creates a structural edge in cost, speed, and the quality of service that's really hard for competitors to match if they're still working in silos. And agentic AI in particular pushes beyond just making existing processes faster. It starts to enable totally new ways of operating, entirely new business models, like this idea of the do it for me or DIFM economy.
Okay, DIFM, do it for me. We'll come
Yes.
back to that. So we see how it works behind the scenes. Where do these transformations make the biggest difference inside the bank? Is it mainly back office stuff, or does the customer actually feel it?
It's really hidden everywhere. But let's start with the back and middle office, the sort of nerve center. This is where AI often delivers the most immediate, measurable bang for the buck, driving what the report calls hyper-automated operations.
Hyper-automation. Sounds intense. Like getting rid of paperwork bottlenecks? What kind of numbers are we seeing?
Yeah, exactly. Take loan processing and underwriting. It's being transformed from end to end. The report mentions institutions cutting loan processing times by like 50% to 70%. That's huge. There are tools out there now, like one mentioned from Abrigo, that uses GenAI to do complex risk assessments in literally seconds, work that used to take hours.
Seconds versus hours. Wow. What about compliance? That's always a huge cost center for banks.
Big impact there too. Compliance and reporting, especially around KYC and AML anti-money laundering. AI tools can monitor transactions constantly, flag suspicious activity much more accurately, and even auto-generate draft versions of those suspicious activity report SARs for a human compliance officer to review and finalize.
So it frees up the humans to focus on the really tricky cases.
Precisely. It handles the volume and flags the high-priority stuff. Reduces the manual slog, but more importantly, improves the quality of detection. Remember that HSBC example? 2 to 4 times better detection, 60% fewer false positives. That helps banks avoid massive fines.
And I guess none of this works if the AI can't actually read the documents it needs to process.
You got it. That's where intelligent document processing, IDP, is critical. It's kind of an enabling tech for a lot of this. IDP uses AI to not just read, but understand and extract the relevant bits of information from unstructured documents, think invoices, contracts, emails. It kills off manual data entry and feeds the automated workflows.
Okay, so operations get hyper-automated. What about managing risk itself? Is AI changing how banks think about risk?
Definitely. It's enabling next-generation risk management, moving beyond static rules to dynamic, predictive models.
When you say next-gen risk, what's the core shift? Is it about seeing problems before they happen?
That's a big part of it. Take credit risk. Old models often struggled with thin-file borrowers or small businesses. AI can look at way more data transaction histories, supply chain info, real-time economic signals to build a much richer, more accurate picture of risk. This allows banks to say yes more often, potentially, and lend more broadly, but with more confidence, not less, often leading to lower default rates down the line. It's about being smarter and more predictive.
And fraud. Always a cat and mouse game.
AI shifts fraud detection from damage control to proactive defense. Instead of finding out about fraud after the money's gone, AI algorithms analyze patterns in real-time transaction details, location, device used, usual customer behavior to spot anomalies as they happen. They can often block potentially fraudulent transactions before they're even completed. The report mentions a new GenAI model for MasterCard projected to boost detection rates by 20%, maybe even up to 300% in some scenarios.
Preventing the fraud entirely, not just cleaning up after. Okay, that's a major shift. So back office, middle office, huge efficiency gains, better risk management. What about the front lines, the customer experience?
This is where things get really interesting for the long haul, I think. While the efficiency stuff is massive internally, AI's impact on the customer experience could fundamentally change what banking feels like for you.
Okay, so how does this AI wave change things for me, the customer? How does my regional bank interact with me differently?
It enables what the report calls hyper-personalization. This isn't just sticking your name in an email. It's AI systems analyzing a whole tapestry of your data spending patterns, maybe life events inferred from transactions, stated financial goals to deliver genuinely one-to-one experiences,
Like what specifically?
like tailored product recommendations that actually make sense for you,
Yeah.
customized financial advice, marketing offers that arrive exactly when they might be relevant. The report suggests mature personalization efforts can boost conversions by 10–15%, even increase revenue up to 25%. It's about relevance at scale.
And those chatbots we mentioned, they get smarter too.
Much smarter. They evolve into the 24/7 digital banker. These GenAI-powered virtual assistants like Erica at BOFA or Finn at Chase can handle complex back-and-forth conversations anytime, anywhere. This frees up the human bankers to deal with more complex, sensitive issues where empathy and judgment are key. High-value advisory work, not just basic queries.
Okay, and does it go beyond just reacting to my questions? Can AI anticipate what I need?
Yes, that's the next level. Proactive, empathetic engagement. An advanced AI might notice patterns in your spending that suggest you're planning a big purchase, like a house, and proactively offer relevant mortgage information or advice. Or, say you submit a complaint, GenAI can analyze the text or voice call, understand the sentiment, summarize the core issue for a human agent, and even flag your emotional state, maybe frustration or anxiety. This lets the human step in with more context and hopefully more empathy.
That proactive part is interesting. So, hyper-personalization, 24/7 access.
Yeah.
Sounds great for the customer, but what about the regional banks themselves? Their whole traditional edge was supposed to be the high-touch personal relationship. Does AI kill that or maybe enhance it?
That is the crucial question for them, isn't it?
Oh.
And you're right, that traditional high-touch advantage has actually been getting eroded lately because the huge national banks have been pouring billions into tech, offering slick digital experiences. But AI actually gives regional banks a powerful way to fight back, to reclaim and even strengthen that relationship mode. It allows them to deliver a kind of high-tech and high-touch experience
High-tech, high-touch, how does that work?
by augmenting their human bankers. Imagine a relationship manager going into a client meeting, but their AI assistant has already synthesized all the recent client interactions, flagged potential needs based on data analysis, maybe even drafted talking points. The tech handles the data crunching, freeing the human to focus on the relationship, the strategic advice, the empathy.
So AI does the prep work. The human delivers the insight and connection.
Exactly.
Mm-hmm.
And there's another fascinating angle. AI acts as a geographic equalizer. Studies are showing that banks using AI more effectively are actually better at lending to businesses located far away from their physical branches. They lend more, with lower interest rates, and see fewer defaults compared to traditional banks lending at a distance. AI can analyze data to replicate or even surpass that old-school local knowledge.
Wait, so a regional bank in Ohio could get really good at lending to a small business in Oregon just using data and AI.
Potentially, yes. But here's the catch. It's a double-edged sword. If they can lend nationally, the national players or even other tech-savvy regional banks from anywhere can compete more effectively in their backyard too. Competition can now come from anywhere.
Right. Opens up opportunities, but also threats from new directions. Okay, you mentioned agentic AI being a real game changer, taking us towards that do-it-for-me idea. Let's dig into that.
Yeah, connecting the dots. Agentic AI isn't just making things faster, it's enabling fundamentally new ways banks can operate and serve clients. It's the catalyst for these new models.
So if RPA is the hands, ML the brain, agentic AI is like the autonomous manager. Is this where banking itself gets reimagined, pushing into that do-it-for-me DIFM economy?
I think that's a good way to put it. With agentic AI, you're not just asking for a task, you're delegating a goal.
Yeah.
And the AI figures out the steps, plans them, executes them. It really does turbocharge this DIGM idea in finance. Clients can essentially outsource complex financial management tasks to their bank's AI.
Okay, give me an example. What does agentic AI in action look like in this kind of autonomous bank?
Okay, for a commercial client, imagine an AI agent acting like a financial GPS on steroids. You give it the goal. Optimize my company's cash flow and minimize borrowing costs. The agent could then autonomously monitor all their accounts, integrate with their accounting software, predict cash shortfalls or surpluses, maybe automatically sweep excess cash to pay down debt, suggest optimal times to draw on a line of credit, even proactively negotiate payment deferrals with suppliers if needed. This kind of proactive, holistic financial management was previously only really accessible to huge corporations with big finance teams. Agentic AI could democratize it.
Wow, like an outsourced CFO that runs 204/7. That's a very different kind of banking relationship.
It is. And internally, banks could use agents for things like intelligent treasury and liquidity management. An agent could constantly watch cash flows across the entire institution in real time, predict funding needs way before humans would spot them based on end-of-day reports, and maybe autonomously initiate internal transfers or flag the need for short-term borrowing.
So, managing the bank's own money much more dynamically. What about risk and compliance? Can agents handle that autonomously too?
Imagine a self-correcting risk and compliance framework. An agent detects a high-risk transaction pattern. Instead of just creating an alert, it could autonomously block the transaction, initiate an investigation, maybe assign subtasks to other specialized agents like a data retrieval agent or a regulatory cross-check agent, and compile a complete digital case file, all in seconds, ready for human review. It could even monitor external regulatory feeds and proactively suggest or even implement necessary changes to internal bank policies to stay compliant.
Okay, so the bank becomes this highly automated, self-managing, self-correcting entity, at least in some areas. This brings up a wild thought. If my AI agent is talking to my bank's AI agent, who's really the customer, does the human get cut out?
That's the paradigm shift, isn't it? The bank's customer might literally become another algorithm. This leads to what the report calls the rise of agentic commerce. In this future, it's not just banks using agents. You or your business might deploy your own AI agent to manage your finances.
My own financial agent. Doing what?
Well, imagine your small business needs a loan. Your AI agent could automatically query the APIs, the digital doorways of dozens of banks, retrieve their current loan terms and rates, analyze them against your criteria, and select the best option. Maybe even initiate the application, all without you lifting a finger.
Okay, that completely changes the game. Banks aren't marketing to me anymore. They're marketing to my agent.
Essentially, yes. Success in that world might depend less on flashy marketing campaigns or branch networks, and more on having really good, transparent, easy-to-use APIs and data feeds that other AI agents can understand and work with effectively. If a bank isn't agent-friendly, it might just get ignored by these automated financial managers. It also forces a massive rethink inside the bank about controls, who's accountable when agents make decisions, maybe even new management structures.
Yeah.
We could see roles like AI agent orchestrator or head of autonomous governance.
Agent orchestrator. Wow, okay, so connecting all these threads, hyper-automation, hyper-personalization, agentic systems, what does the regional bank actually look like in, say, 2030? Its identity must change.
It has to. The regional bank of 2030 will likely be structurally different. Its business model will need to diversify beyond just taking deposits and making loans. Its workforce will be this hybrid of human and machine intelligence. And even its physical branches will serve a different purpose. AI unlocks possibilities for new business models and revenue streams.
Like what else could they do?
Well, embedded finance is a big one. Banking as a service, or BOSS. This means embedding their core banking functions, like payments or lending, directly into other companies' platforms. Think getting a business loan right inside your accounting software, powered by your regional bank behind the scenes. Low customer acquisition costs for the bank, seamless experience for the user. They could also package their AI capabilities into AI-driven advisory services. Imagine offering an outsourced AI-powered CFO service to small and medium-sized businesses in their community who can't afford a full-time CFO. And potentially, with very careful ethical considerations and anonymization, some form of data monetization providing insights on local economic trends based on aggregated anonymized spending data, for example.
Okay, so new ways to make money. What about the physical branch? Does it just disappear?
Probably not disappear entirely, but the future of the branch is definitely not transactional. It evolves into more of a high-value experience center.
Think less about depositing checks, more about complex consultations, planning a mortgage, retirement advice, small business strategy sessions, maybe community events, tech support hubs. The staff shift from tellers doing routine tasks to tech-savvy financial guides focused on relationships and complex problem solving.
A completely different role for the branch and its staff, and the overall workforce of the future. You mentioned the hybrid model. Is it mostly about job losses or job changes?
It's primarily a story of transformation, not just elimination. Yes, AI will automate many tasks currently done by humans. Some estimates mentioned in the report suggest maybe up to 30% of traditional banking tasks could be automated. But it's more about a massive shift in what people do. AI augments roles like relationship managers or loan officers. It takes away the tedious admin, the data entry, the report pulling, freeing them up to focus on the strategic, creative, empathetic parts of their job, the human parts.
So AI handles the what, humans handle the why and how. Kind of. And new roles emerge. Huge demand for data scientists, AI and ML engineers, people who understand AI security, AI ethicists, prompt engineers who know how to talk to these systems effectively. The required skill set becomes a hybrid. You need the financial knowledge plus data literacy, critical thinking, and fluency with AI tools. Continuous learning isn't just a buzzword, it's survival.
Okay, this sounds like regional banks have some big strategic choices to make. They can't be everything to everyone, especially with limited resources compared to the giants.
Exactly. The report frames it as a strategic trilemma. Do they double down on being a hyper-local community anchor, really leaning into that relationship model, augmented by tech? Or do they become a niche digital player, focusing on a specific customer segment or product nationally, powered by best-in-class tech? Or do they try to become a scaled regional competitor, using AI to achieve efficiencies and expand their footprint? The point is, they probably can't do all three well. They need to make a clear, deliberate choice about their identity and strategy.
And underlying all those choices is the people problem, right? Getting the workforce ready.
Absolutely. The report calls it the great upskilling. It might be the single biggest internal challenge. Banks simply cannot hire their way out of this. There isn't enough external AI talent, and it's too expensive. Success hinges on a massive, sustained, company-wide commitment to reskilling and upskilling their existing people, making their current workforce AI fluent. It's a multi-year journey.
Okay, we've painted this picture of incredible potential efficiency, personalization, new models, but let's get real. What are the roadblocks? When a regional bank actually tries to do this stuff, what makes it so hard? This path seems riddled with challenges.
It absolutely is. The implementation gauntlet, as the report puts it, is formidable, especially for smaller institutions. First off, you have major technological and financial hurdles. The biggest one is often the legacy system dilemma. Most banks are running on old core banking systems, decades old sometimes. They're siloed and flexible and just weren't built for the kind of data flows and integrations modern AI requires. Trying to bolt AI onto these old systems is incredibly difficult and expensive.
So the foundations are shaky for building this new AI house.
Okay.
It's a lot of technical debt.
Huge technical debt. And that directly feeds into the data readiness problem. AI is garbage in, garbage out. If your data is messy, inconsistent, locked away in different incompatible systems, which is common, your AI models won't work well. Or worse, they'll produce bad results.
Yeah.
Just getting the data cleaned, standardized, unified often requires a massive effort, frequently involving a big, costly migration to the cloud.
Okay, so tech and data are big hurdles. What about the money?
That's the investment barrier. Implementing AI isn't cheap. There are high upfront costs for technology, data infrastructure, specialized talent, and it can be really hard, especially for smaller regional banks, to demonstrate a clear, positive return on investment in the short term. That makes it tough to get budget approval from the board and keep projects funded.
Right, you need patient capital. Okay, tech, data, money. What about the people side?
Big challenges there, too. Talent and cultural barriers. First, there's the war for talent. Regional banks are competing not just with the giant Wall Street firms, but with Google, Meta, Amazon, every tech company out there. for the very small pool of experienced AI professionals. And frankly, they often can't match the salaries or the cool factor projects.
So hiring is tough. That puts even more pressure on training existing staff.
Exactly, which leads to the upskilling mandate. The report cites a stat something like 57% of financial institutions admit they have significant AI skill gaps. That points to needing a fundamental overhaul of training and development programs, which takes time and resources. And even if you have the tech and the training, you have to deal with cultural resistance and change management.
People digging their heels in, fear of the unknown.
Yeah, absolutely. You get institutional inertia. We've always done it this way. You get employee fear, is this robot going to take my job?
Yep.
You get resistance from departments protecting their turf. Overcoming that requires really strong, consistent leadership from the very top, communicating the vision, explaining the why, and showing people how AI can augment them, not just replace them.
Okay, tech, talent, culture, and then there's the regulatory minefield, right? Banks are heavily regulated.
Hugely important. The regulatory risk and trust imperatives are critical. First, just navigating the regulatory maze. It's complex, it's still evolving, and it's fragmented. There isn't one single AI rulebook for banks yet. But, and this is crucial, regulators have been very clear, existing laws still apply. Consumer protection laws, fair lending laws like the Equal Credit Opportunity Act, ECOA, they all apply fully to AI systems. There's no advanced technology exception. You can't say, oh, the algorithm did it. The bank is still responsible.
And that connects to the black box problem, doesn't it? If you don't know why the AI made a decision.
Precisely. That's a major risk. Some complex AI models are like black boxes. Data goes in and answer comes out. But the internal logic is incredibly hard to decipher. This clashes directly with rules like ECOA, which legally requires banks to provide specific reasons if they deny credit, for example. You can't just tell someone the algorithm said no. So explainable AI, XAI techniques to make AI decisions more transparent and auditable isn't just a nice to have, it's becoming a legal and operational necessity.
Need to be able to show your work, essentially. What about bias? We hear a lot about AI inheriting human biases.
A massive concern highlighted in the report: algorithmic bias and fairness. If you train an AI model on historical lending data, and that data reflects past discriminatory practices, the AI will learn those biases. It might learn to associate certain neighborhoods or demographic groups with higher risk, even if it's not explicitly told to. This can lead to discriminatory outcomes like digital redlining, where certain groups are unfairly denied credit or offered worse terms. It's a huge legal risk, a massive reputational risk, and a serious ethical issue. Banks need rigorous testing, bias detection tools, and ongoing monitoring to prevent this.
And underlying all of this, the tech, the regulations, is the fundamental issue of trust, right? Banking runs on trust.
Absolutely. Building and maintaining customer trust is paramount. If people become suspicious or fearful of how banks are using AI, maybe worried about privacy, security, or fairness, that trust can erode very quickly. The report notes that public trust in organizations using AI responsibly is still quite low, maybe only around 26% of consumers. So banks need to be proactive with transparency about how AI is used, ensure rock-solid data privacy and security, and always maintain clear human oversight and accountability pathways. Trust is incredibly fragile.
So many hurdles. It sounds like moving first is risky, but maybe waiting is even riskier.
That's the pioneer's dilemma exactly. The early movers face high costs, unclear ROI, and navigate regulatory uncertainty. But the report suggests the cost of waiting too long might be even higher. You risk falling so far behind the tech curve, behind the big banks and nimble fintechs, that catching up becomes impossible. You lose competitiveness. Timing, strategy, and execution are everything. And because most regional banks can't build all this sophisticated AI in-house, they'll rely heavily on third-party vendors, which makes vendor risk management, doing due diligence, ongoing monitoring, absolutely critical.
Okay, given this daunting gauntlet, what are the key things regional bank leaders absolutely must do? What are the strategic imperatives?
The report lays out a few core imperatives. First, develop a coherent AI strategy. Don't just chase shiny objects or let departments run off doing their own little AI projects. AI adoption needs to be tied directly to the bank's overall business strategy, with clear goals and measurable outcomes.
So strategy first, then technology, not the other way around.
Exactly. Second, adopt a phased, value-driven implementation roadmap. Don't try to boil the ocean. A big bang AI transformation is likely to fail. Start with the no-regrets moves, maybe back-office automation using RPA, things with clear ROI and lower risk. Use the cost savings from those early wins to fund more ambitious, complex initiatives later, and build using modular components you can reuse.
Smart. Start small, show value, build momentum. What else?
Third, forge strategic partnerships to bridge capability gaps.
Okay.
Recognize you can't do it all alone. Actively seek out and partner with fintechs, specialized AI vendors, maybe even universities, to access technology and talent you don't have internally. But as we said, this means elevating third-party risk management to a core strategic function.
Makes sense. Leverage the ecosystem.
Fourth, embed responsible AI as a competitive differentiator. Don't treat ethics, fairness, bias mitigation, and transparency as just annoying compliance hurdles. Make them core principles. Build strong governance frameworks. Invest in explainable AI. Conduct regular bias audits. In the long run, being the bank that customers trust to use AI responsibly could be a powerful competitive advantage. Trust is a durable asset.
Trust as an asset. I like that. And the last imperative, it comes back to people, I assume.
It always does. The fifth imperative is to lead human transformation from the top. The CEO, the board, they need to champion this. It requires a dual talent strategy. Yes, recruit a small core team of deep AI experts. But more importantly, launch a massive ongoing upskilling program for your existing workforce. The goal isn't to turn everyone into a data scientist, but to create an AI-fluent organization where employees understand the capabilities and limitations of these tools, feel comfortable working alongside them, and can help identify new ways to use them. This investment in human capital is probably the single most critical factor for long-term success.
That was a really comprehensive journey. It's so clear that AI isn't just some add-on for banks. It's fundamentally reshaping their operations, their business models, their workforce, and crucially, their relationship with all of us, their customers. An incredible mix of opportunity and really significant challenges ahead.
Absolutely. The future for regional banks is being written right now. It's a story of adaptation, strategic choices, and navigating this complex technological waves. How they respond will really define the financial landscape for years to come.
And maybe a final thought for you, our listener, to chew on. In this coming world of agentic commerce we talked about, where your own AI agent might be managing your money and interacting with your bank's AI, what does trust actually mean then? How does that relationship with your financial institution, which we always thought was built on human connection, change when your financial co-pilot is increasingly an algorithm? What qualities will you look for in a bank to make sure it earns and keeps your trust in that AI-powered future? Something to think about.